Doesn't need an introduction, but Rob Engel is the Michael Armelino Professor of Finance, New York University Stern School of Business, and of course won the 2003 Nobel Prize in Economics. He's also the director of the Volatility Institute. Rob is, of course, well known in the academic community and well known to this community as a person who's done a wonderful amount of time series econometrics, including all of the things normally associated with them, Garch, Kogarch, everything in the Garch family. And I think today he's going to be talking a little bit about time series analysis, skewness, and volatility, systemic risk. Rob?
Well, thank you, Richard, and thank you, David, and it's nice to see all of you here today. I've enjoyed my interactions with IFE over the years, and what I'd like to talk about today is actually very fresh. This is a talk that I gave maybe a week and a half ago at the SOFI meeting in Geneva. And for those of you who don't know about SOFI, you might be interested in it. It's the Society for Financial Econometrics. And it has an annual meeting. We had the first in New York last year, and the second was this year in Geneva. Next year it will be in Melbourne. It's designed to include practitioners, financial engineers, academics, and it's doing very well, and I think you might enjoy it. One of the things that I am also wanting to say is, which was part of the meeting, is that my good friend and colleague, Sir Clive Granger, passed away a couple of weeks ago. And just in case you don't know that, he is the man that I shared the Nobel Prize with. And you can see us here in the front row in Stockholm in 2003, sort of wondering what's going to happen. What's the future going to bring? And this is a topic that he saw 6 years of, and we are going to see a lot more than that of it. What is the future going to bring? We're in the middle of a financial crisis, or I don't know whether we're in the middle or not, but anyway, we have a financial crisis, and one of the things about it is it's a very complex web of many different features that are facing us. The Stern School last fall put its collective mind together, and 30 faculty wrote a series of 20 white papers on different aspects of the financial crisis, which was published as this book last spring. And I encourage you to take a look at it when you're, because it's actually got a lot in common with the Obama proposals for how to restructure the financial system. It has a lot of insights on derivatives markets, and housing markets, and what to do about securitization and so forth. It seems to me when you take this whole thing and you sort of try to boil it down into its key features that from this make this whole book, I think there are two themes that you see over and over again. First of all, you see that risk was mismeasured. And I think that this is not just a problem of risk managers, it's a problem of throughout the financial sector. We see it, traders, money managers, bank CEOs and boards, rating agencies, regulators, and even investors miscalculated the risks that they were taking in a lot of securities that were, and a lot of positions that were put on. But on top of that, there were very powerful incentives for many of these same participants to ignore the risks. And these two aspects are intimately related. And this organization is probably more focused on the first question than the second, but the second one, it sounds like, is the topic of this afternoon and is actually tremendously important in trying to fix this system. So I will focus primarily on the first one, but I think maybe when I'm done you might see some themes that would be relevant for the incentive structures as well. So, should we have known? Would a good econometrician or a risk assessor have known that the financial crisis was coming? Perhaps we should put it a little more sensibly. Would the crisis have been in some kind of a confidence set? If you have a forecast of what the world is going to look like a year ahead, would the crisis have been within a 1% boundary of what we could imagine? Was there information that risk assessment typically missed? And if we built more economics into our risk management, would we have had a better chance to see what was coming? So I'd like to sort of take these ideas and move a little bit forward with them. I mean, the common measures of risk that we use, the value at risk and expected shortfall and volatility forecasts, are all typically measured over short horizons. They're typically calculated at a 1 or a 10-day horizon, but even the 10-day horizon is usually just a scaled-up version of the 1-day horizon. So, in a sense, I think one of the features we should say about primary role we use in risk management is that it's focused on short-run risk. But many of the positions that are being evaluated are held a lot longer than the horizon of which these risk measures are appropriate. And consequently, there is a risk that the risk is going to change. In other words, when you hold it over a longer horizon and the risk goes up, either because the volatility goes up or the credit spreads go up or something like that, then you've already taken your capital loss and it's too late to get out of the position. So there was a component of the risk which was change in the risk. So one interpretation for I think what happened is that because we had low volatilities, low borrowing costs, low credit spreads from 2003 through 2000, really the summer of 2007 pretty much, a lot of these highly leveraged positions didn't look so risky. But they didn't look risky when you measured them on a short-term basis. On the other hand, a lot of people foresaw that volatilities were likely to rise, and so that the long-run risks looked probably a lot bigger than the short-run risks, but we didn't have a good set of tools to talk about the long-run risks. How do you measure long-run risks? Well, the main thing we have in our toolkit are some scenarios or stress testing, which are very appropriate, I think, good ways of measuring long-run risks. But there are some more things that we can say about how to calculate long-run risks. And I think this is a challenge for our profession to come up with some more useful ways of talking about what are the long-run risks that face investors, and how do we incorporate these in our decision-making? Can we use economic information to do this? And can we calculate in a sensible way long-run estimates of VAR and expected shortfall? So let's just take a simple example of this. Suppose you wanted to calculate a 1% quantile of the future distribution of stock prices, and you're going to do this by simulation. How should you do the simulation? Well, we often do it with independent shocks, but in fact, if you do it with shocks that allow for these changes in risk, such as this asymmetric volatility model that's written at the bottom there, you can calculate the long-run distribution of returns, do it many, many times, and see what the 1% quantile of this distribution actually looks like. And suppose you did that on August 1st of 2007, which is more or less when financial markets first started going up. So you would estimate the model up through the end of July, simulate this thing for 4 years out, calculate the 1% quantile. I've drawn two curves on here. One is the 1% quantile if you use the Tarch, this threshold arch model, which was on the previous slide. Assuming that the shocks are going to be normally distributed, that's in green, and if you assume that they're going to be bootstrapped from the empirical distribution, you get the red curve. And what you see is that it's not, this 1% point is not that far off what actually happened a year and a quarter later. If you did the same thing starting in January of 2008, so we've already been through some of this, you see a kind of a similar story. You do look like you exceed the 1% point sort of a year in advance, but not by very much. If you did it starting in September 1st of 2008, so this is now just like 8 days before Fannie and Freddie were taken over, and maybe 2 weeks before the Lehman bankruptcy, what you see is that the 1% quantile was exceeded by what happened. But in terms of do we foresee these things, it's not clear we should start on this date. This is like a worst case date to start on. We sort of want to average over them all. And so my sense is that these quantiles are not unreasonable pictures of what happened, and that really the outcome is probably like within a 1%, more or less a 1% scenario that we're seeing for these long horizon risks. As captured by this very simple model. If you think that there are a bunch of other models, and I've just put these on the slide, not because I want us to go through them or memorize them or anything, but for reference, several other asymmetric volatility models. The first one was the Tarch model. There's EGARCH, asymmetric power arch, nonlinear GARCH, and asymmetric square root GARCH, which is a sort of an affine model. You get pictures which are pretty similar. This is again starting from August of 2007. Interestingly, the one that's most conservative is the bootstrapped threshold arch. The others all pretty much move together. And if you do this now, actually it was, I guess it was probably June 1st that I did it. You see that the S&P, this is the S&P, I should have mentioned, maybe you can spot that. The S&P, of course, if you look at 2 years, what the 1% worst case it looks like, it looks pretty bad. You know, I don't think we've crossed these lines yet, but read the paper today, maybe that's where we're headed, I don't know. But in any case, you know, we want to be continually keeping in mind what these long-run risks look like. Another aspect of these quantiles is that the distribution that comes out of these simulations is skewed. It's negatively skewed. It has a long left tail. And the skewness is an interesting property. One of the questions is this a property of the data and that we should know and understand, or is it not? And it turns out that these asymmetric volatility models, where negative returns predict higher volatility in the future compared to equal positive returns, have the property that they generate skewness, negative skewness in the data. And in a picture which kind of tells this sort of simply, on the right is a two-day binomial tree where if it goes up on the first day, the volatility is low, and if it goes down on the first day, the volatility is high. So after 2 days have gone by, we see an asymmetric set of outcomes. There are 4 possible outcomes, but no longer are they symmetric, even though each day they were symmetric. And this is how you get this long left tail. The big market declines and this quantile that goes down a long way happen because down markets lead to higher volatility in the future, and therefore there is the possibility of even further declines. And of course, if you kept on doing this, you would see that the left tail would grow a lot. In the short run, on the left-hand side, the return can be written as the standard deviation times some shock. And if this shock is symmetric, then the short run skewness is going to be 0. And so in the short run, this effect doesn't matter. This doesn't show up particularly. It's only when you do the time aggregation or the long run that you get the skewness effect. And so let's take a look at what is implied by this model. First of all, the heavy orange line is the skewness that you get in the data. This is the S&P since 1990, and what you see is that if you calculate the one-day returns, there's a slight negative skewness. If you calculate the 2-day, 3-day, 4-day, up to 50-day returns, the skewness becomes more and more negative. So this is just in the data, and these are overlapping returns, but they're over almost 20-year period. If you do the same thing for all these models that I've just mentioned, what you calculate for the simulated skewness is, first of all, in the short run, they are not as negatively skewed as the data is. So the data is even more negatively skewed than these models. The ones that use the bootstrap error distribution have more negative skewness in them at the beginning, but after just a few days, those also turn out to be less skewed than the data. So here's the data, here's the bootstrap distributions, and here are the ones with normal shock. But as you move out further, you see that the data actually comes in the middle, and here is the curve that we've been sort of thinking of as the extreme one, which is this threshold arch model, and that now is more negatively skewed. And in fact, if you go out to 1,000 days, which is 4 years, you see that the skewness of the data actually comes back up towards 0, whereas these models continue to produce negative skewness, and in fact, this one produces really substantial negative skewness. So one thing that it's important to recognize from this is when we talk about skewness, it's important to describe what data frequency we're talking about, because we see much more negative skewness for long horizon returns than for short horizon returns. And secondly, we see that these models do an imperfect job of capturing exactly what's in the data. On the other hand, maybe it's close enough, or maybe there's another model that we haven't thought of that would be even better. When we're doing this simulation, we can do a few other things too. We can calculate the expected shortfall for all these different horizons. We can calculate the probability of very extreme events by using extreme value distribution and calculating the tail parameter at each point in this horizon. And if you do this, you use a Hill estimator to estimate the tail parameter using a Frechet tail or an extreme value tail or a Pareto tail. You get pictures like this, which show how this tail parameter changes as you simulate further and further out into the future. And you can more or less think about these as degrees of freedom parameters for a t-distribution, if you like, for the lower tail. And here is our friend, the bootstrapped T-Garch model, and that has the most extreme tail because this is the smallest parameter. When you go up further, some of them are moving back toward normal, and some are in between. But from this, we have a distribution theory for the whole tails of the distribution, and we can talk about what is the if 1% quantile isn't far now, what is the 1/10 of a percent quantile, and how do we calculate expected shortfall? We can do all those things from this theory. So what hinges on this? Well, one thing that hinges on this is the probability of default. In a sort of a Merton model of default probabilities, we say that a firm is going to default when its stock price falls below some default threshold. And of course the question is, what is the default threshold? And one way of calculating this default threshold is to suppose that we know the probability of default from, say, the credit default swap market, and we would use the simulated distribution to tell you where the default threshold really is. If you do this in a one-factor model that is shown at the bottom there, then you can calculate the default threshold for any stock, and then what you need to know are two things. You need to know what's the market return over, or the factor return over this horizon, and what's the idiosyncratic shock over this horizon. And not surprisingly, in scenarios when the market goes down a lot, it's much more likely you'll cross the default threshold than when the market doesn't go down a lot. So that we can see that defaults are intimately related in this model to how much market decline we observe. This is actually spelled out in a paper that I presented to IFE a couple of years ago, and it's in this paper by Bird and Voronov. So, just to take this a step further, let's suppose that we have a portfolio of identical firms, and they all have a beta of 1 and a common idiosyncratic volatility. Then they all have the same probability of default. Then we just have to calculate the default frontier for the representative firm. And if we use one of these models for the market factor, we can actually calculate the number of defaults. And what it turns out is, for example, suppose we assume that the probability of default is 1% a year. That's maybe optimistic today, I don't know. But in any case, in each scenario that we run of the market factor, we can calculate the probability of default for each of the firms, and we can therefore get a loss distribution from this process. And when the market declines a lot, the probability of default is high. When it doesn't decline very much, the probability of default is low. It averages out to 0.01 across scenarios, but for each scenario, it's different. And if you want to calculate the correlation between defaults, you can do that very simply in this model. It's actually just the variance across scenarios of the probability of default divided by p times 1 minus p. So if we do this with these models that we've just been simulating, and we look at the 1% worst case of the loss distribution, you can see, for example, for the threshold arch model, the losses in the 1% worst case in 1 year would be 10%. By the time you get up to 5 years, it would be a 30% loss in the 1% worst case. If you do it with the bootstrap distribution, it rises up to, in 5 years, to half the firms in the 1% worst case would have defaulted. Now this all assumes the model is constant and correct representation, but what this is saying is that this negative skewness and these big market declines are actually systemic risk. This is what we think of as systemic risk. When the market declines a great deal and half the firms are crossing their 1% default threshold, that's what we mean by a systemic crisis. And so that's the reason the title of this talk includes, well, it includes systemic risk. It also shows up as systematic risk. But I think really I want to emphasize the systemic risk aspect of this. And you see the other distributions are similar, although not quite as extreme. If you look at default correlations, you see default correlations could rise up to 20%, 25% under various scenarios. And this is for equity returns that have a correlation in I think 0.1 or 0.2, I don't remember exactly what it is for this. So the skewness in the market factor, long-run skewness, is indeed, I think, a systemic risk and something that we need to talk about when we talk about long-run risks. This model can be enhanced. It's a very simple model. It can be enhanced by adding more Garch terms for the idiosyncratic volatilities, by allowing some correlation between the idiosyncrasies, and by allowing for systematic changes in the volatility that through this spline function that possibly you know about. These things are all described in a recent book I did, which talks about this wide range of correlation models that can be used for this problem and many others. Well, one of the questions that I'm sure we should pay attention to is, are these models adequate for talking about this long-run skewness? Now that we're saying that this is actually a potential way of evaluating systemic risk looking forward, these models are awfully simple to be giving us such rich implications. So at least one thing we might do is try to test the hypothesis that the long-run skewness coming out of the models is consistent with the data. In fact, we saw that it wasn't exactly consistent with the data. So what the test does, in words, is it says, okay, let's take a model that we've estimated. Estimate this model by maximum likelihood, and then simulate it, just as I've described, a bunch of times, and calculate the theoretical skewness for different horizons from this model. Then take each data point in the sample, calculate the long horizon returns from those data, cube those, divide them by the variance to the power 1.5. That should be an unbiased estimate of the skewness, and subtract the model skewness and see whether this difference is systematic. You can do that by a conditional moment test, which is basically a least squares regression of a vector of ones on the derivatives of the likelihood function with respect to the unknown parameters and this new moment condition. And you get a t statistic. And when you do this, you get t statistics, which reveal sort of what we might have expected. For example, for the t-arch, the threshold arch model, the 10-day horizon t-statistic is bigger than -2. So we might say, for the short horizon, we have underestimated the skewness by using this model. For the asymmetric square root arch, we've exceeded this 2% for the 10-day, the 50-day, the 100-day horizon. So it doesn't have enough negative skewness at any of those horizons. But this is all assuming we use normal shocks to do the simulation. If we use bootstrap shocks, it really cleans up this picture quite a bit. We no longer have evidence that the Tarch model is misspecified at the short horizon, and none of them seem to be misspecified at the short horizon, at least at the 2% point. The only real evidence is that the long horizon seems to be the skewness seems to be overestimated by this bootstrap model, which we have seen as extreme in all the cases we looked at. There is, however, an issue as to whether the sampling distribution of this test is really adequate. because we're using a lot of overlapping data, and I'm using heteroscedasticity and correlation consistent covariance estimation, the best one that I can find, but this is a big problem. And if you actually do a Monte Carlo, what you see is the empirical critical values are, for the downside, it's actually bigger, more negative than 2, and for the upside, for the longest horizon one, it might be that the critical value is actually 10. So with a 500-day horizon, we get really bad finite sample properties of this test, which suggests that maybe we can't really reject this hypothesis even at the long horizon. So what that means is that these models seem basically capable, at least if you use the bootstrap shocks, they seem basically capable of replicating, at least within statistical significance, the properties of the data. So now I'd like to turn away a little bit from the econometrics and talk a little bit more about the economics. Where does this asymmetric model really come from that so much of what I've said has been based on? Well, it really comes from a very famous paper by French, Schwartz, and Stambaugh in 1987, who pointed out that surprises in the volatility of a stock should be negatively correlated with returns. How does that work? In words, when the risk premium on an asset increases unexpectedly, the asset automatically has a negative price move. When the risk premium goes up, what does that mean? That means it has to be at a lower price that we're willing to hold the stock. So some people are going to sell the stock until the price equilibrates. The price is going to equilibrate with a negative shock. So any change in risk premium leads to an offsetting movement in asset prices. And particularly if the risk premium is related to the variance, then, as we'll talk about in a second, then surprises in the variance of a market portfolio or an aggregate wealth portfolio should be negatively correlated with returns on this portfolio. This is something we see all the time in markets. We see that the returns and volatilities are negatively correlated. If you look at the VIX and the returns, tremendously negatively correlated. And this is not just a random thing. This is a natural result of efficient markets and economic behavior, and gives rise to things like rising volatilities in falling markets and high volatilities in bear markets. These are things we all know to be true, and I'm just giving you a little more of an explanation for why they're natural things that happen. We can go a little bit further in trying to build this into our volatility models. Campbell and Schiller have a decomposition or a way of writing returns in terms of the future. In other words, the returns today are equal to what they were expected to be as of yesterday, plus two shocks, one of which is the shock to future expected returns, and the other is the shock to future cash flows or dividends. And so a stock will change its value partly because its dividends and future earnings have new information, and partly because the required return or the risk premium associated on this stock changes over time. And those two factors are sort of fundamental drivers for all the volatility we see. So we can talk about this shock to, this is the one that's interesting from the point of view of today, because we wanted to know if risk changes, how does that change prices today? Well, this term gives an expression for it. It requires the updating the expectation using yesterday's information set compared with today's information set compared with tomorrow's information set of the discounted value of all these future expected returns. And this is the same thing for all future dividends. So how do we take a model like that and connect it with these volatility models we're talking about? And what we want to show is that asymmetric volatility is really the outcome of that argument. So I'm going to give a little stylized version here. Suppose we have the simplest version of risk premium, which is that the expected return is proportional to the predicted variance. And that we'll define the surprise in volatility as the difference between the variance predicted 2 steps ahead tomorrow and the variance predicted 2 steps ahead today. So that's a natural way of talking about what's new in volatility. And if we do the same thing for many steps ahead, P plus K, then that's just proportional to the new information of 1 step ahead, or we might assume it is anyway. In which case, we can write the returns as whatever they were expected to be, the volatility news, which comes in with a negative coefficient, and the cash flow news, which comes in with a positive coefficient. So we have these 2 pieces of returns every day, just as I said before, one of which is a surprise in volatility, and the other of which is a surprise in future earnings possibilities. And what the Garch models are trying to do is they're trying to model the variance of the left-hand side. And so if you calculate the variance of the left-hand side, you can see it depends on the variance of this term, the variance of that term, and the covariance between them. And so that's kind of the problem here. We're modeling this thing, whereas, in fact, on the right-hand side of that same equation is the innovation in this variance. So there's the difficulty of getting these 2 pieces to work together. But what I want to show you, first of all, is that we can define what this volatility innovation is for any of these Garch models, and we can see how important it is in returns. How big is this term compared to returns as a whole? So, for example, we can say the returns at t plus 1 depend on a constant, returns at time t, and then the shock to volatility. What is the shock to volatility? Well, for an asymmetric Garch model, it's this term. It depends on what the difference between squared returns were and what they were expected to be. And in an asymmetric case, there's another term as well. You can do the same thing for these other kinds of volatility models. And so we can get time series of the innovations in volatility. And if we do those, we can look at correlations between the surprise in volatility and returns. And these are extraordinary, it seems to me. First of all, let me start with the second column. This is the T-Garch model. And you see a correlation of bigger than minus 0.6 between daily returns and the surprises in volatility as measured by this asymmetric Garch model. If you look at the asymmetric power arch, you see even more negative. E-Garch, square root Garch, and N-Garch, they all have correlations which are between minus 0.6 and minus 0.8. The first column is the VIX. It's the rate of return on the VIX. And you see that is very similar to these others. So that in fact, the change in the volatility, whether it's measured by the options market or whether it's measured by the Garch model, is very highly correlated with, negatively correlated with returns, just as implied by the French Work-Standball model, and just as we get from these, statistical analyses of the data. If you do it for different sample periods, it seems to be pretty stable over time. And if you actually work with this particular square root Garch model, which is like an affine kind of model. Then it turns out you can get a closed form solution for how all this works, and because each of these variances and covariances on the right-hand side can be pulled together to get a single model, and that's shown on here. But so this economic argument tells us that asymmetric volatility is a result of this risk premium argument, or potentially, anyway. It's perfectly consistent with it. So, what about building economics into this in other kinds of ways? How about an economic risk model? Could we do an economic risk model? Well, often we can foresee risks in the far-off future, but how do we use these risks to plan our investments and our asset allocation? And how do we measure them? What's the link between sort of thinking about an economic risk and calculating risk measures? I mean, it's fine to say, well, the CEO has to do that, but maybe we have some things we can say to help out. I mean, for example, some of you may have heard me give a talk which I gave a lot of times between 2004 and 2007, which was basically, why was volatility so low? I mean, we don't give that talk anymore. Why is volatility so low? It sounds ridiculous, doesn't it? But in any case, I gave a lot of talks on why is volatility so low? Because we could see that we had big budget deficits, we had balance of payments deficits, housing prices were skyrocketing, credit quality, credit spreads had dropped to zero. How can we have such low volatility? And my argument at that time was that this was just short-run volatility, but the long-run volatility was substantially higher than what we were seeing. And ultimately, these factors would come into play and lead us to, out of this low volatility environment, to a higher volatility and higher correlation environment. Actually, the options market typically was quite steep in its term structure over this, particularly the latter part of this period, suggesting that financial markets actually foresaw that volatilities were likely to rise. They weren't going to stay this low. Most people thought that interest rates weren't going to stay this low. I mean, so was this somehow built into our risk measures? I don't think so. I mean, maybe it was in some cases, but I think in a lot of cases it wasn't. So how could we do this? Well, an example might be the Spline-Garch model that I did with Gonzalo Rangel, that was published a year ago. And the Spline-Garch model basically tries to take macroeconomic variables and introduce those into a volatility model. And essentially, what we did was we looked across 50 countries at the financial market volatility in these countries and tried to correlate that financial market volatility with macroeconomic indicators to see under what macroeconomic events the volatility was high and under what macroeconomic scenarios it was low. So what did we find? Well, we found that the key macroeconomic indicators of high volatility were, first of all, high inflation, but second of all, slow output growth and recession. So when you've got a downturn, you tend to have higher financial market volatility. But also very interesting are the last three factors, which are all macroeconomic volatility measures. The volatility of short-term interest rates, the volatility of output growth, and the volatility of inflation all were important explanatory variables for when financial market volatility was high. So this says that when the macroeconomy is bad in either inflation or recession terms, or uncertain, so that we can't predict very well where it's going to be, and it's changing from time to time, those are both indicators for high financial market volatility. And it seems to me a lot of what we've seen can be interpreted in this way. Certainly, we have not been clear exactly how much of a recession we're going to have. Great Depression was talked about a lot, maybe not so much anymore. Inflation is still a topic of conversation. Actually, it's a reviving topic of conversation. Certainly, we've had lots of fluctuation in short-term interest rates, and macroeconomic uncertainty is a big issue. So I think a lot of the financial market volatility is interpretable in terms of economic and macroeconomic uncertainty. So maybe we knew this was all going to happen. Were we prepared? Well, obviously we weren't, but I think more importantly is to ask the question, what would it have meant to be prepared? How would we be prepared? As we talk about this, it sounds like we're talking about market timing. When we know that volatility is going to go up, we ought to get out of the market. When we think it's going to go down, we ought to get back in the market, or something like that. But market timing, we know, is a pretty perilous strategy for how you want to manage a portfolio. So what are the alternatives to thinking about this in terms of market timing going in and out of this portfolio? Well, it seems like the main candidate we have for understanding this is Merton's intertemporal capital asset pricing model, which says we can hedge some of these long-run risks. If you think that volatility is going to go up, you can hedge that. You can buy volatility. So I want to take that argument a step or two down the way, see if we can see in the asset pricing implications for that, and think about what its implications are. So in the ICAPM, there may be many risk factors, and these factors can reflect future investment possibilities. So if we want a hedge factor, and I guess we might think about risk factors and hedge factors as being inverses of each other. A hedge factor is a factor that is going to maybe not do particularly well in good times, but it's going to pay off well in bad times. And you like to put that in your portfolio because, well, in bad times, when everything else is going down, this factor goes up, and so it reduces the overall risk of your portfolio. In the ICAPM, we tend to think that there is a way of pricing all these factors, a multi-factor kind of model, and it often is written with a pricing kernel that looks sort of like this. It's a linear combination of these factors, and in the one-factor model, there's just a B times this factor, and in the one-factor model, we know that the B is supposed to be negative because stocks that are correlated with this factor are less desirable, they have higher risk premiums, and that is translated into a negative B. I don't know whether I want to look at this, but basically it says we can get from this kind of a pricing kernel, we can get an expression for the expected returns on the stocks, and it depends on the covariances between each of these factors and any particular asset. And if those covariances are translated into a beta, then it really just depends on the variances of the factors. Let me show you for a two-factor case what this looks like. If we ask, in a two-factor world, what is the expected return on the second factor? And let's suppose the first one is the market factor. Then we have a risk premium which has two terms. One is the covariance between the market factor and this factor we're hypothesizing, and the second is the variance of the second factor. So if this second factor is not a hedge factor or a risk factor, its B is going to be 0. So it's going to be priced based on its covariance with the market. This is the standard beta pricing model that we know about that depends on its beta. But if this is a hedge factor that's going to pay off in bad states of nature, then what we know, because there's a minus sign out here, is that the risk premium on this factor ought to be negative. Because we have to pay something to buy a hedge. We can't expect an excess return from holding a hedge that's also going to pay off in bad states of nature. So that this B2 is going to be positive, unlike the B1, which is going to be negative. And so the difference between a risk factor and a hedge factor is that the sign of the B in this pricing kernel is going to be the opposite. And that gives us a testable characteristic, which we can take a look at. So what would we expect to see? We would expect to see, when we substituted all the same apparatus we did, we would expect to see the opposite behavior for a hedge portfolio of what we see for a risk portfolio. That is, when its variance surprisingly increases, we would expect to see prices increase rather than decrease, because it becomes more valuable as a hedge when its variance goes up. So we would expect to see its asymmetric volatility model be backwards. So for a hedge factor, we think the asymmetric volatility should be of the opposite sign. Should be the opposite of what it is for a risk factor. The positive returns on a hedge factor should predict more volatility in the future than negative returns on a hedge factor, rather than the standard asymmetric volatility, which says negative returns have a bigger effect than positive. And correspondingly, this time aggregation argument should say we ought to expect positive skewness for these hedge factors. Well, let's see what we get. We have a website at the Volatility Institute at Stern, which is called VLab, or Volatility Laboratory. It follows about 100 assets a day. A bunch of them are currencies, and I don't think currencies are natural candidates for this. So every day we estimate volatilities and forecast them out to a year. We calculate correlations for many of the assets. These include equity indices, international equity indices, individual stocks, sector indices, corporate bonds, treasuries, commodities, as well as currencies. I thought the website was on here. I don't know. You can find VLab. It's a public website by Googling VLab NYU or something like that. And so I encourage you to take a look at it. It has a lot of... Is it on there?
Yes.
Oh, I see. It's just, I can't... There it is. So it's vlab.stern.nyu.edu. And so at the end of May, we actually looked over all these assets at how many of them had asymmetric volatilities and which direction did they go. Here's what we found. Oh, these are the names. A lot of names. So what did we find? We found for all these T-Garch models that they all had the standard normal risk asymmetry, where negative returns have the biggest effect on future volatility, except for government bond fund, the corporate AA bond, not fund, but index, BAA index, swaps, 2-year, 5-year, and 10-year swap rates, gold, and the VIX itself. If you think about volatility as an asset, then you can think of the VIX as having a price. And we also did, I don't know, 5 other volatility series, and they all have the opposite volatility effect. So these are our candidates for hedged portfolios. If you do it for eGarch, you get basically the same thing, although General Motors shows up in this category. If you do it for the 2 of these other models, we get no contradictions. So what assets do we expect to be hedged portfolios? Well, if you're worried about deterioration of the economy, what might you hold for a hedge portfolio? You might hold treasuries, or you might hold gold. When we're heading into a recession, treasuries turned out to do well. But treasuries, because interest rates go down, treasuries go up in value. It's a familiar, common hedge against recession. I don't know whether gold is a good hedge or not, but in any case, many people think it's a good hedge. So that would say when these assets are becoming more volatile, their prices go up. Surprising volatility for these assets leads to greater demand for them. What about credit deterioration? That's another thing we really were worried about. You might really want to hedge that. How would you do that? Well, you could do that with a credit spread. High grade minus lower grade bonds. It's a way of taking a position in the credit spread. That turns out to have the same hedge style asymmetric volatility. Haven't done it with CDS yet, but that's another candidate for the same thing. And it's expensive to hold treasuries because they don't have any kind of return. But maybe that's, again, because they have this hedge characteristic. And that's where the pricing happens. In any case, what are some other long-run risks we might be interested in? So does that mean we ought to buy commodities and real estate? If we're really seriously worried is going to surprisingly affect us, then we should think about war and terrorism. Should we buy military stocks? What about heating? Should we buy green stocks and energy stocks? You might say, have already been priced because of this. What it means is that their expected return is lower because they have a negative risk premium until the day comes the planet goes up in smoke and they get valuable then. Okay, anyway, just, if you want to see regression output, here's the VIX. You run a regression of the rate of return on the VIX and here's the asymmetric term, which would normally be positive, but for the VIX. If you do it for the default minus BAA bond prices, see again the negative coefficient here, very significant. You do this for a bunch of different that you would think of as that you might think of stocks that some of these other things. Well, you see, there are a bunch of these stocks that all come in with hedge-style asymmetries. Evergreen Solar Fund, Power Holding, Canadian Solar, JSO. And then here's a military stock. Lockheed comes in with asymmetry. So, what's the conclusion? I mean, I've given you a lot of stuff. It's a lot of pieces, but I think they're telling kind of a story that if we really want the long-run risks seriously, we have to think about how do we forecast them, how do we measure them, and how does it affect our portfolio? One of the explanations for how it our portfolio decisions is we ought to hedge these long-run risks. And I think this is a great challenge for the people in this room as well as the financial sector as a whole. And we've hedged these risks. The financial markets would not have collapsed the way they did. That's a conjecture, and something that needs research because ways of hedging it really shift the risk. They don't really but what have we said? Let's pay attention to long-run risks as well as short-run risks. I've introduced a new test for long-run skewness. It does appear that long priced in the financial markets, and the test that we look at, which is just looking at the asymmetric volatility, seems able to distinguish risk portfolios from hedge portfolios in a really very interesting way. So let me stop here and we'll take.
Was excellent. Really confused me because if hedging is a zero-sum game, how would hedging the markets?
Okay, so it's a question of, well, there are two pieces. First of all, hedges. If you're talking about buying treasuries, you're not talking about a zero-sum hedge. You're talking about investment asset classes. A lot of these stocks that showed up just, long positions. If you think about volatility, we're talking about, and there we've got people on both sides. The reason it might still have an effect, back to discussions about the 87 crash, are that if you felt obliged to hedge with volatility derivatives every time your volatility, you would not be taking this big. If you priced in the market, it would become even more expensive if a lot of people, and consequently, you would shed this risk, pass it on to people who are able to take the risk, and that's obvious. That's the question you're getting at. But if we can this OTC market in arrangements, then the counterparty risk from would be certainly reduced, eliminated, and so I think that basically the price that would be important. Yeah.
Yeah.
From the perspective of an investor portfolio that has this hedge, how do you know that that ultimately you're not spending more money on it? You have that you are actually better off by doing this, or there's an uncertainty that the shocks occur, you're paying a lot of money a long time before.
Absolutely. No, I think that's, in an equilibrium world, that price would be the price of disastrous events which may happen for a long time. A lot of money for that. You'll be able to tell your clients or your boss or whatever why you're doing this. And so what's the alternative to that? So the it seems to me, you're telling him, we think there's this long-run risk. It's too expensive to hedge it, so we're going to dynamically hedge it in the sense that we're going to synthesize this position by getting out of the market just before the bad stuff happens. And I think that's exactly, that's not equivalent. And we know it's not equivalent.
Yeah, but suppose just simply that it may just be that the price of these things is so high compared to the benefit that you shouldn't be doing it, they just ignore it. And once in a while you get, you go through a cycle and you're still better off. Is that possible?
And you get bailed out.
Two related. One is, I mean, many investors hold portfolios that have some equities and some bonds, which is a natural hedge.
Right.
And what you're saying is you're just accepting a low long-run rate of return.
That's right. I think that's right. I mean, investors do that. I mean, you're not a 60-40 investor unless you've given up some return for hopefully some reduction in risk.
But my other point is, in your first slide, you talked about two causes. So one had to do with incentives. Okay. Now, the risk-return trade-off behind everything is based on a utility function of an investor who doesn't want risk and wants return. But if you're an employee of a company, there's no reason why that should be a utility function.
Yeah, sure. So that's right. So this whole argument is based on, the incentives being that of maximizing utility for the investor. And that's really not the world we live in. So, I think those are separable and both important questions. And I think we really do have to straighten out a lot of these incentives, some of which are these bailout incentives and underpriced government guarantees that we have, and some of which are the compensation packages, and some of which are the rating agencies. And I mean, all these incentive things complicate this process dramatically. Yeah.
Thank you very much for this beautiful presentation. On the long run, how do you distinguish in an econometric model what is volatility and what is uncertainty on the dynamics? And on the long run, don't you think that the uncertainty of the dynamics has a bigger impact and also for systemic risk than the volatility model?
So you're talking about when you're doing a Garch model or something like that, the dynamics of this model determine this long-run skewness?
Yes, that's when you have, especially when you have a systemic event, as we had, that there is some, speed up of the dynamic effect that pushes you towards some downside attractor that overwhelms all the volatility impact. So the question is like you're, close to a fall in the water, and the question is whether you are going to fall into it or you are not. And the volatility is just, the uncertainty on the short run. But at some point, the question is whether you are going to fall, you are not going to fall. And how can you account that in this type of volatility model and distinguish between the two effects, which I think both of them have a very big importance?
I agree that these volatility models are doing an awful lot of work in this thing, and basically the structure of them is very ad hoc. It's just an empirical observation. We don't know that those structures are going to continue in the future, and I think that's a topic of a great deal of interest. How do you make a volatility model more economically based rather than statistically based? That being said, I'm surprised at how well these models have actually done through this financial crisis. In some of the work we've done, it really looks like even the multi-step volatility predictions, if you did them on an everyday basis, recursively, not seeing the future at all, it looks like they've actually survived quite well through this financial crisis, so that better than any of our portfolios did. So basically, at least the short-run risk and maybe up to a month risk was measured fairly accurately by these ad hoc models, and I think I don't know that I'm getting to your question, but that's a related answer.
I agree with you, but it's still a question for me.
You're going to need to tell me a little better exactly what these two factors are, yes?
Yeah, great point on bailouts, but to go back to your earlier point about where you mentioned about fixing the OTC markets, it seems like there may be a bit of if the movement toward exchanges or even clearinghouses could work against the ability to do what you're proposing, is to be able to hedge a lot of different risks, because only, especially on an exchange, only very heavily traded products are going to survive.
Sure.
And even a clearinghouse, you need a large amount of standardization. So it seems like implementation of yours would require the capacity to still be able to do bespoke models.
Oh, yeah. Well, I mean, if this were sort of a recognized need, then maybe there would be enough business in the standardized products. I mean, I don't know how much business there are in variant swaps. People who are in the business say there's a lot, but
Was
maybe.
Let's take the other side.
No, I don't share actually the view that everything is going to move to centralized clearing. I do have some views as what you want to do with the remaining bespoke part, which has to do with transparency and so forth. But but I don't really. I mean, if we're talking about hedges that a large proportion of investors would feel like they want to invest in, wouldn't this become a big enough product that it could move to centralized clearing? And wouldn't actually some of the inefficiencies and expense of this market perhaps be reduced by standardization and increased volume?
A lot of it's going to depend on the underlying risk, if that is something that can be decomposed. Well, I mean, what OTC traders do now is they take a very unique risk, a unique-looking risk, and they try to tear it down into things they can hedge separately. Now, whether or not you can do that, and whether or not the investors are going to be able to do that same thing, it's hard to say. Maybe there's a few that there'll be enough volume to support an exchange traded or at least a cleared product. But there's bound to be some more unique risks in some places that people want to hedge, but they'll have to do it in a very specialized way, have to be intermediated.
You mentioned models that worked well, surprisingly well during the crisis. What would have, do you have any sense of why, perhaps, but what kind of circumstances would have broken the model? Where do you think this reaches a limit?
Well, I expected that we would see that the longer run forecasts would be seriously wrong. And in this case, we only did up to a month, so it's not really as much as showing pictures here. But and what it turns out is the month-ahead forecasts, when you look at a long historical period or actually theoretically from the model, have a distribution. And if you look at this distribution that occurred from September to December, it's within the 1% tail of what, from 1990. And so that's the sense in which I said it wasn't broken, but it was still an extreme event. The one-day ahead forecasts, in fact, they were almost in the median. I think what happens when you go to a month ahead, when we simulate these models, each day is an innovation which doesn't depend on anything that happened before that. But I think that in what we observed, we had strings of bad news days that wouldn't have been expected by the model. And I think that's why we're down toward the 1% point of the distribution. And that's what I think goes wrong with it. I mean, not wrong with it, but I mean, I think that's what we observe.
Well, it seems to me that including these extra hedge terms in the plan, with the extra costs associated, would have as a consequence the lowering of the prices of assets, and therefore would have as a consequence avoiding the bubbles possibly, and maybe creating a climate into which lower stable growth would be the norm. So it would be like keeping in the back of your mind that yes, irrational considerations, always there are these risks included in the asset prices. And we are in a system like math in the markets. The object of your study is being affected by its study. So therefore, you were observing corresponds to the period where these hedges were not taken into consideration. So therefore, this might affect the long-term dynamics. And if this gets propagated and accepted, and there might be very beneficial, let's say, for the long term, because we might be able to avoid or at least have less severe crisis and less pronounced bubbles if the prices were. So I will comment on that. Also, my other question would be, well, this is all...
Probably one's enough. I think that I'm not sure I follow all the parts of your question, but I do think that if we had a long-run perspective, that financial markets would not be so quick to invest in things which turn out to be bubbles. I mean, that, we all sort of, if you can identify a bubble, let's suppose something is a bubble, and actually there's a lot of times in our history when at least the newspapers are pretty convinced that what we're seeing is a bubble, but prices still keep going up. So if you really had a long-run perspective, you'd certainly hesitate to invest in these, at least to the extent that I think we did. So I think the bubble theories don't work if there's a long-run risk objective. And I think correspondingly, if you invest in a bubble and then you decide you're going to hedge it, basically you're not going to end up really having invested in it because your hedge is going to be just negative of the bubble. So I don't know exactly what would undo it. But so I kind of think a long-run objective like this would reduce the tendency for the markets to irrational exuberance. Yes.
You picked the 1% tail level, and I presume that's because you believe it's the appropriate level for a long-term investor to be hedged, or how? If not, what do you suggest? If you're saying people should be looking more long-term, what level is appropriate to be looking at?
Well, I picked it because we use 1% for VAR. Why do we use 1% for VAR? I'm not really sure. I don't think that's a very fundamental notion. I could have done any point. I mean, I had the whole distribution. It was just a matter of what I was going to present to you. So what would be the right thing to do? Essentially, I have, through my simulations, a picture of what the future possibilities are and the probabilities of each one of them, if I really believe my model. So if you have some loss function, we can just put that on top of it. And so that's one of the reasons I've calculated these defaults, because that's another kind of a loss function you might be interested in from this distribution.
I guess the question I have is, what does this mean for monetary policy? Because Central banks target GDP inflation when they set interest rates, and they try to get to efficiency concerns to minimize inflation volatility in GDP. But it sounds like they should be including their long-term risk in their monetary policy.
I don't. Volatility is not necessarily, low volatility is not a goal, because volatility is a risk in the markets, but it's just a reflection of information. And so I think what you do is you set monetary policy to best achieve your macroeconomic stability that you want. And then financial markets take the news that comes out of this monetary policy and optimize themselves, and that's where the volatility in the financial markets comes from. Now, that being said, I would agree that the monetary authority probably does want to take into account some stability of monetary policy, rather than just a bang policy that has a lot of short-run volatility in it. But I think they already do that. So I wouldn't put that into this category as well. I do think that there is scope for, and this is a whole different topic, which I thought you were headed for augmenting monetary policy by some kind of capital controls or tax on systemic risk. So that would be the connection that I would emphasize with the financial markets.
Thank you, Ron. Okay. Is not quite evenly divided on successes and failures. We're going to start at my far left with Peter Carr, who is, I think, going to talk about successes. He's been kind of scraping the barrel for successes of financial engineering. So with no further ado, we'll start with Peter.
Okay, thank you. It's a pleasure to be here. And thank the organizers for having me. So, as Rich said, we're talking about successes and failures in financial engineering. And, the press, of course, has validated many of the failures. And so I think, now is a propitious time to re-examine our roots. So for this panel, I thought I would do that. So I think most people would agree that financial engineering experienced a fairly big breakthrough in the 70s, I mean, perhaps the 60s, when this notion of delta hedging of options was first raised. And so in the 60s, a book by Thorpe and Kassouf called Beat the Market was published. And that book, by the way, is available nowadays. You can go to Amazon and pay $400 for it. Or you can go to Sheen Kassouf's website and download it for free. So take your pick. So I did the latter, and I took a look at the book. And I found that, indeed, there is a discussion of delta hedging in that book. And what the nature of the discussion is that they were actually looking at convertible bonds. And they were imagining taking a position in convertible bonds, and then also taking a position, it would be a short position, in the underlying stock. And they were calculating by regression the number of shares to hold, so locally there was what we now call zero delta. Okay, so they were not talking at all about continuously revising the position. They were rather sort of keeping track of this delta, which sort of started at zero, and then they could see that as the price moved, it was no longer zero, and then sort of eventually it got too big, and then they would rebound. So that was the nature of their contribution. It's right there for everyone to download. So then, of course, in the early 70s, a more difficult argument, I would say, was proposed actually by Robert Merton, which was based on continuous revision of a delta hedge. So that is based on a model now called Black-Scholes, where there's many conditions required for this hedge to work. things like no jumps in the underlying price, that volatilities are constant, that you know that constant, that there's no transactions cost, and so on. And we all know the long list. So, of course, when one actually attempts to implement this strategy in practice, it doesn't work. So, meaning there's variance in the P&L, and and now I think the pertinent question is how much. So so that's what I decided to look at, and I'm going to be asking for. I'm going to do a little informal poll in a few minutes. So listen carefully, and I'll sort of explain what we did here. So this is joint work with Liren Wu, who's a full professor at Baruch College here in the city of New York, and we looked at S&P 500 index options. We just focused on those with 1 month to maturity. And they were always at the money when we took a position in them. So what we did is, starting in 1996, we would sell an option and hold it to its expiry without any kind of delta hedge. So then we would take the next option, at the beginning of the next month, sell it, hold it to its expiry, record the P&L. Do this every month until January of 2009. So we included last year. And so we then have a P&L on every single trade that we did, which is, again, selling an at-the-money 1 month option and holding it to its expiry. Then we can compute the variance of P&L from this time series. Okay, so we get a number, okay, which is the variance. It's actually the mean squared error, to be absolutely precise, the mean squared error. And so then we repeat the exercise, and with a more complicated strategy. So now the strategy is what we'll call vaguely delta hedging at-the-money options. And let me describe it more precisely. So beginning of 1996, we again sell an option, but this time we furthermore take a position in the futures on the S&P 500. And we use the Black-Scholes formula. It's a call that we sold on the S&P 500. And so we use the Black-Scholes formula for delta, which many of you know is like, actually the black version is E to the minus RT and V1, okay? And we actually revise that, and we revise daily. And every time you revise, you have to supply a volatility input. And also you have to supply a volatility input when you start. So we use the implied at the time we revised or took a position. Okay, so that's what we're doing to delta hedge. It's the most sort of naive way one could imagine implementing Black-Scholes delta hedging. Just hedging in the day, using the closing futures price, using the Black-Scholes delta to evaluate the running implied. And we again get the P&L. We again record the mean squared error of this P&L. Okay, so now we're comparing these two strategies. One is just selling calls. The other is selling calls and delta hedging daily, using Black-Scholes at the running implied. And so there was a reduction in variance, I will tell you. Okay? So now the question is how much? So there's going to be 3 choices. And I'd be very interested if people would please volunteer their opinion as to what the empirical reduction in variance was from this strategy. So there's going to be 3 choices, and I'm going to go through them all before I ask for a show of hands. So the first of the 3 choices is that the variance was reduced by 1/3 or less. Okay, so if I have a complicated number here. Oh, I keep saying variance, it's actually mean squared error. But anyway, so the mean squared error, I mean, if it was 100, then to say it was reduced by 1/3 or less means that actually, so if the mean squared error from just selling calls was 100, then the mean squared error from selling calls and delta hedging was between 67 and 100. Okay, so it was reduced by 1/3 or less. Okay, the next choice, as you would guess, is that the variance was reduced by between 1/3 and 2/3 of the 100. Okay, and then the final choice is that the variance was reduced by more than 2/3, like up to theoretically the maximum theoretical possible of 100%. So okay, so I think that's a fair way to kind of do a little survey. So okay, so now I'm going to go through those 3 choices in order, and I would really appreciate it if people would please choose one of the 3 and not keep their hand down. Because I think it's important to actually, see what reality is for this model that's been much valued of late. Here we go. So those who think the reduction in variance is between 0 and 1/3, the first choice, please raise their hand. Okay, thank you. Those who think it's between 1/3 and 2/3, please raise your hand. Okay, thank you. And those who think the reduction in mean squared error is more than 2/3, please raise your hand. Okay, thank you. So it was an informal show of hands, but based on my, eyeballing it, I would say that the most hands were raised for between 1/3 and 2/3. Okay, so the actual answer is that the mean squared error is reduced by 88%. Okay, so the correct answer was more than 2/3, and some people got the correct answer. Congratulations. Okay, and so anyway, I myself, I will confess, did not know the answer to this question 2 weeks ago, and I don't know what I would have said without looking at it. So, anyway, for those who sort of got it wrong, don't feel bad, because I actually did a survey at Bloomberg where I work of how people would answer, and most people at Bloomberg themselves, first of all, answered it was like less than 2/3, so the wrong answer, but also predicted others in this group would. It's a very austere group. It's just that it's very difficult to do this back testing. I'm very privileged to have Luren Wu consult for Bloomberg, and he put in a lot of time actually to do this back test. And so I think the point I'm trying to make is that there's the failure, let's say, of financial engineering is actually communicating its success. So to the media, let's say. So and I'm castigating Bloomberg News along with the rest. And there's just, we've all heard much casual talk